Good morning, everyone, and welcome to this first panel on the final day of the Greenwich Economic Forum. My name is Alice Fulwood. I am the Wall Street correspondent for The Economist based in New York, and I'm delighted to be hosting this panel at the GEF today, asking some of the world's top institutional investors about their views on the economic outlook and the investment landscape. It has been a wild and volatile year as the world and asset markets have struggled to cope with the spread of COVID-19 and uncertainty around that and other events like the US election. With the creation of an efficacious vaccine, investor focus is shifting to 2021 and beyond, and what themes will prove important for asset prices in the future. I'm thrilled to have with me two investors poised to discuss their outlook for next year and beyond. The first is Alain, a Senior Managing Director and Head of International and Europe at CPP Investments, the Canadian pension fund which holds more than $300 billion US dollars worth of assets under management. I'm also joined by Jaensubhakij, the Group Chief Investment Officer at GIC, the Singapore-based global asset manager with more than $100 billion in assets under management. Welcome, Alain and Jeffrey.
Thank you.
Thank you.
Good morning.
So great to have you both with us this morning. First of all, could you sort of both in turn explain what your perspective was coming into 2020 and what themes your portfolios were positioned to take advantage of before COVID-19 struck, and how you've had to adapt as the virus spread? I guess we'll start alphabetically. Alain, why don't you go first?
I mean, we have a well-diversified portfolio, so we weren't facing any specific themes. Other than obviously some continual technology disruption, logistics, so on and so forth. Clearly, less focus at the time on what would happen to cities and some of the decoupling issues that we're seeing now. But the portfolio was strong, well diversified. We invest across 55 countries. We actually have very little of our ongoing investment in Canada. We are focused on the emerging markets as well. So we thought we had built a resilient portfolio that was well positioned at a time when valuations seemed to clearly be challenging. And we were looking forward to continuing our deployment across the emerging markets. We stated very publicly that we would expect the portfolio to be up to a third into emerging markets by 2025, where we see a lot of growth coming. That frankly is up. We're about 22% today in a growing pool of capital. We have net inflows plus investment returns. At the time, we saw this as a significant deployment of capital into emerging markets. The COVID pandemic has basically caused us to pause it a little bit, but at the end of the day, I think our long-term trajectory remains unchanged.
Yeah, I think for us, we came into 2020, maybe a little bit concerned about the length of the cycle. At that point in time, we'd had one of the longest ever recoveries. Unemployment rates were at all-time lows, in the US, in some countries in Europe, and elsewhere as well. And valuation certainly reflected, a lot of the growth that had already happened. So I'd say we were somewhat cautious, but with no real reason other than the thought that valuations were high, the system had a lot of credit in it, and we were just a little bit concerned. And so actually just thought we should go into the situation maybe taking a few chips off the table, being a little bit more defensive, but certainly with no view as to imminent danger at the time.
And how are you both now dealing with the outlook for recovery from this year? Obviously, we just had news of the Pfizer's sort of efficacious vaccine. How does that sort of change your perspective? And I guess, how did your investment sort of weather through some of the changes over the past few days as people have sort of reckoned with that development? Why don't we go to Alain again?
There's a lot of questions in there. At the beginning of the pandemic, we obviously had to focus on capital preservation. We had a lot of companies that needed capital that were actually sound, very solid companies, but that for a number of different reasons, lockdowns and so on and so forth, saw their business model come to grind to a halt. So We preserved capital and managed to look after these portfolio companies to ensure that their continued growth post-pandemic would be robust. So we paused a little bit. Then we obviously saw a number of trends accelerate during the pandemic, which we took advantage of. If you want to think about, some of the logistics, some of the work from home trends, telehealth, so forth, we've taken advantage of a number and positioned ourselves quite strongly across a number of these themes. It's too early to tell, actually, I think, what the shape of the recovery, quote unquote, will be. But the vaccine clearly is good news. We've seen a bit of a resetting of capital markets, and some companies have held back, and others, the more traditional, I call them old economy businesses, have actually seen a bit of a rebirth the last couple of days. I think this is going to be volatile for some time. From our perspective, our portfolio is robust and well diversified, and so we are keen to be able to reinvest. If you look at the inflows into our fund, they're very much subject to levels of employment in Canada, prospects for the Canadian economy. We receive dividends and distributions from assets that we own, and that basically determines the amount of capital that we want to deploy in any given year. We are fully deployed at all times, so we don't keep cash sitting around. So it's a matter of it's a relative trade between the assets that we choose to invest in. At the beginning of the pandemic, we could easily see in a negative scenario these cash inflows into the fund dry up significantly, and so this was a more static approach to capital management. Now, the much more positive scenarios emerge in terms of the inflows into the fund from companies, from distributions, from the employment situation in Canada. So actually, we're very much back in business and investing going forward on some of the themes that we think are going to emerge as accelerated and winners from this new cycle.
Yeah, I'd very much agree with Alain that this is really good news, but it's still a little uncertain as to how quickly we'll actually be able to get vaccines distributed to a wide enough set of the population to really sort of be able to normalize life and the economy the way we'd like to see it. I think part of the good news is that given that the Pfizer vaccine looks like it has great efficacy, and the kind of pathway that it works through is also attempted by several other vaccines, so maybe that gives hope that more than one vaccine will be available, and some might be easier to transport and distribute as well. So I think that's all good news. And I think in the last year, really what we've seen, or last 9 months rather, is a significant divergence in economic performance and also asset performance between sectors and countries that have handled things well or haven't been so negatively affected by COVID. Technology, very obviously, many of the things that where demand has grown as a result of COVID, so delivery, e-commerce, delivery services, e-commerce, and so on. But anything else that really required, face-to-face contact, people being out and about, really suffered a great deal. Suffered in terms of drawdown in demand, and the vaccine really gives, for the first time, a glimmer of hope that these, have a pathway to come back in a time frame that the markets can start to factor in. So within, call it 6 to 9 months, you could start seeing that come back in a significant way. So even though we're going through another period where it looks like some kind of restrictions on mobility is needed to prevent any further spread, at least I think we can look beyond that to middle of next year, and so this allows us to look at some of the assets like hospitality, assets that involve travel, that I think previously folks wouldn't have looked at before, just because of the uncertainty.
I wanted to pick up on something that Alain had mentioned, which is that they have to manage sort of inflows. Sorry, they don't operate with sort of much dry powder, basically. But my understanding is, Jeffrey, that's sort of different at GIC, and that you sort of do have some cash on hand. Could you maybe explain sort of what what like high conviction ideas you might have for that dry powder as you enter 2021.
Yeah. So as I mentioned, we entered 2020 a little bit, concerned about valuations and so on. And just fortuitously, that meant that we had a little bit of cash on hand. One of the fortunate things was that during the downturn, as a result, any of the portfolio companies that we owned, if there really was going to be a need for additional capital injections or needed any additional growth capital and so on, we felt that we were prepared to put that in. I think what we've seen, of course, is that actually prices have come right back up in terms of valuations to even higher levels than where we began with many of these sectors, and so that doesn't look like a tremendous opportunity for us. I mean, I think we're quite valuation sensitive around some of these, but there are a lot of sectors for which valuations have lagged, haven't come back at all, and I think those are where there may still be opportunities to put money back to work. And that includes many of the emerging markets. Alain and my organization are both fairly active in some of the Asian markets, for example, some of which have had a pretty tough time in terms of battling COVID. And the valuations and asset prices have certainly lagged. And so I think there are opportunities in these countries and these sectors to put additional money to work in 2021.
I guess just picking up on something that Jeffrey highlighted there, the idea of geographical sort of diversification rather than sector diversification. There's been a lot of focus on sort of the winners and losers in certain industries, but I know that you both sort of focus a lot on emerging markets or sort of different geographic regions and weighting your investments accordingly. Could you talk about sort of which geographies you're sort of most excited about or most heavily exposed to for 2021? Alain, why don't you go first?
Yes, I mean, we think diversification for us is frankly is key to how we manage our portfolio. It makes it resilient, and I think that's why we weather the current volatility really, really well. But also, building for the future, as we have no outflows, cash outflows from the portfolio in a net basis into the Canadian pension system for years to come. I think it allows us to take a very long-term approach to developing value. So we think emerging markets are going to be significant drivers of value, of diversification, where people talk about decoupling. Decoupling can be a risk, but it also could be an opportunity in terms of reducing the volatility of the portfolio. So as I said, we have a focus on emerging markets, up to a third of the portfolio between now and 2029, which is in a growing pool of capital, quite a challenge. But China, obviously, you won't be surprised, is probably the lion's share of that. India, we're big believers in the prospects of India, as I think our colleagues at GIC are as well. I think India will be a significant driver of long-term value. I think when you invest in India from perspective. And then we think other countries in Asia and Latin America will be the bulk of our emerging market exposure. When it comes to asset classes, we're also increasingly well diversified. We invest in just about any asset class globally. And again, the key word here being diversification. Is it listed, unlisted, public, or private? And most of what we deploy is deployed directly. We leverage fund relationships in private equity and to some extent in the hedge fund industry as well. But we've built as our colleagues, we've built a very large team and infrastructure to be able to deploy our capital directly, which allows us to change and vary the portfolio very easily whenever we see increased opportunities.
Yeah, I think,
Jeffrey, same question to you.
Sure. I think for both CPP and ourselves, I think we have very long dated liabilities, if you will, and so we have a little bit of the luxury of a long time horizon to think about what are the regions and sectors that are likely to do well in the long term, and even if in the next 1 or 2 years they may still need to go through some difficulty, it may be worth doing the work and starting to put in place at least the beginnings of some of those future investments. And I'd say that in many of the emerging markets, this past year and then maybe even the coming year is still a tough slog, meaning that there are still so many healthcare issues that need to be managed, and the opening up of borders and travel to allow foreign investors to come in, to allow interest in the economy to pick up again. And all of that will take time. But I think the outlook for some of the emerging markets, especially those in Asia, do look like there are many things to be positive about in the long term. I think all the countries that have been mentioned by Alain, we certainly agree with. China, India, and so on. I think the added wrinkle that we've seen in the past year and a half maybe, is that with the tensions between the US and China, and also I guess between China and some of the other developed countries in terms of relationships not being as clean or as smooth, does mean that China itself has focused a lot on developing its own internal economy and how it's going to bolster the key industries there. So I think as a large domestic market, it's one that just offers many opportunities for us to take a look at and ask, which other sectors that will develop, that look like they will have capital flow into it, where the technology and the human capital are there to develop it. And I think these offer tremendous opportunities. And then separately, because some of the supply chain has already talked about wanting to diversify out of China, many of the other countries are natural recipients of the manufacturing facilities as companies want to diversify their sourcing and diversify the production. And so I think whether it's India, Vietnam, Indonesia, I think these and many of the other countries are also potentially beneficiaries from that angle as well.
Could you could we also focus a little bit on sort of types of different assets that you might be invested in? I know that Alain mentioned the sort of CPP invests across sort of public and private assets. Obviously, in sort of major public markets this year, you saw sort of huge liquidity shocks and sort of volatile sort of trading that maybe alludes to the idea that sort of public liquid assets are sort of not as liquid as you would want in a crisis, but at the same time, sort of private assets that don't offer any liquidity sort of may have posed greater risks to investors with a sort of shorter time horizon than yours. Do you think sort of leveraging illiquid or private assets is something that is sort of very important for diversification? And how do you think about private versus public assets? We'll go to Jeffrey first, I guess.
Yeah, thanks very much. Yeah, no, it was really every time we have a crisis, we're shocked by how liquidity dries up even in the public markets, when you need it most. And I think because of the change in the structure of the market and the amount of capital that participants can put in, particularly banks, I think we've seen even the most liquid markets like treasuries actually become much less liquid. And then in times of crisis, you can't really move much paper at all. So I think that there are a couple of lessons that anyway I think I draw from that. I think the first is that when we underwrite, we have to underwrite to almost with a view of some hold to maturity. That if you're trying to trade in and out of assets, with the expectation that liquidity will be there, I think it's a more dangerous game than it's ever been before. And so, we encourage our investors to look at things like credit and say, are you in there because you expect a gain that you can get out of very quickly, or is it one where the gain will be there, so long as the fundamentals of the company you're invested in will be fine. And that's that's slightly different. And so we're almost forced, even in publicly traded assets, to take a longer term view, almost like a private markets, a liquid asset type of view, about whether we can hold it for a longer period. And then I think at the same time, what's happened over the last few years also is that many assets have become, have kept being remained in the private markets for much longer than they used to be. So, classic case would be technology companies that used to be listed much earlier are no longer listed as quickly. Biotech companies which used to come to the public market early and then come repeatedly for funding can now get that funding in the private markets. And so I think we've had to definitely expand our ability to look into within the private markets, both with partners that we're invested in, GPs whose funds we're invested in, but also even our own teams have to understand kind of what the opportunities are in the private markets much more intensely, just because more and more assets are remaining in the private markets, and if we can't access those, then we might not be able to access some of the better growth opportunities.
And Alain, same question to you.
Well, I could repeat most of what Jeffrey said. I mean, we take the same view. I mean, again, as I said, we have the luxury of long-dated liabilities. And so there's no cash call on the fund in the short term. There probably isn't any net cash call on the fund on an annual basis for decades to come. And so we are partial to assets that can deliver long-term value. And so we probably have, in a total portfolio, public equities are less than 30% of the portfolio. So we've grown our investments in long-dated private securities, whether private equities, real assets, or even credit. And we think that is a good way to manage the portfolio to be able to give you the luxury of time to deliver value for assets. The fluctuations in public markets clearly will show volatility in the value of our portfolio. But frankly, at the end of the day, when you take a long-term perspective, we look at our results on a 5-10 year horizon. We think that that diversification actually serves us well. And it's, as I said, across asset classes, across strategies, between public and private, and between geographies. It's it's a aggressive diversification, which actually enables you to show a much smoother path to returns. And I think this last pandemic shows it well. China's been affected first. Even if the virus originated from China, it seems that their economy is back on track. A number of key economies in Asia are probably going to show a positive GDP. Whereas in the West, we're still struggling with it. And having a well-diversified portfolio, not only by geographies, but by type of assets, allows us to actually smooth that volatility that will be induced by a pandemic like this. We need to maintain some liquid assets to be able to manage cash flows and to be able to return capital to the pension system when they need that capital throughout the year. But I think we are we have built over the years a portfolio that's designed to deliver long-term value and to give you the ability to manage those sets of assets and risk over a long period of time. So we don't react to short-term volatility that much.
Great. I'm going to start taking some audience questions now. So if anyone is watching and they wish to ask a question, I am going to start looking at those. So please do submit them. The first one I have from the audience for both of you is, what are your views on rates in the medium to long term in the Western world, keeping Japan's experience in mind? I don't know whether either of you wishes to seize upon that first. Why don't we go to Jeffrey?
Yeah. Well, I think rates in the long run can't really divorce themselves too much from where rates are at the short end. Meaning that if central banks are determined to keep rates at a certain level, then obviously, and they can telegraph that pretty well, then the 2-year, the 5-year, definitely is linked to that short rate. And I think what central banks have been very clear is that they believe that recovery will be slow, it'll be uneven, and will require monetary support as well as fiscal support as well. So I think the market has correctly viewed that the short end is really well anchored, and that will extend out into the medium part of the curve as well. The question then is can the longer end of the curve move by much, and will the economy and growth and inflation come back in such a way as to cause that to move up? I think there are arguments for both sides, but we are in an economy that has been deeply hurt by the COVID crisis. There's still large percentages of the population unemployed, and so I think that downward pressure, if you will, on the economy will remain for some time, and it will take quite a while for us to be able to work out of it. So I don't see rates moving in very significant ways. There will be a fair amount of volatility, but I think there's certainly a policy intention to anchor rates at these current levels. And I think given the amount of indebtedness, whether it's household indebtedness, corporate indebtedness, or even government indebtedness, certainly the repayment of debt requires rates to remain fairly low. So I think that seems to argue for rates being somewhat constrained.
Alain, is there anything you'd like to add? We have another question that says, have your plans for allocations to real assets changed given the current rate environment? So if you agree with Jeffrey's perspective on rates, maybe you can tackle that one.
I do agree with Jeffrey. I was going to save you time by agreeing with most of what Jeffrey says. I think the level of economics, the scars will take time to heal on the economy. And I was going to make the point, but Jeffrey made it at the end, that I think it's not in the government's interest to see, a significant increase in long-term rates anytime soon, as they have to repay massive new indebtedness. And I think the economy is going to take time to find its feet again, even though we can see a more positive trend now. I think the damage is real to the real economy. It's going to take, especially in Europe, I think some time to heal, and we don't even know to what extent. So I think rates will remain low, definitely for the medium term. And I would agree with Jeffrey. I think my own perspective is probably going to last a bit longer. Real assets have been a challenge. I think you hit a very, very interesting point that we, as a fund, we own almost a quarter of our portfolio is real assets. And I used to run our infrastructure team for years, and I remember what a UK utility that we could buy with an expected yield of 12%, was recently you'd have to fight around the 6 or 7 handle to own that asset, even though you actually were facing some regulatory uncertainty. So I think real assets have become incredibly challenging from a cost of capital standpoint, because remember, our mandate is to earn 4% real on the assets we manage. That's what the Canadian chief actuary tells us is required in the long term for the CPP to be viable. Well, that's 4% real return was the same when I started at CPPIB 12, 13 years ago. It hasn't changed. But what you can earn now on most classes, asset classes, has eroded significantly. And so our hurdle rate has not moved. So from our perspective, you have to say that some real assets today are not delivering the type of actual returns that are required. There's still an anchor to our portfolio. But I think we're going to be very cautious in the near term in terms of what type of assets we invest in, because the returns have come down significantly, and I think it follows from what we just said that we don't expect them to increase significantly in the short term.
Great. I don't know whether, Jeffrey, you want to add anything about real assets, or whether you think Alain's covered it.
No, I think Alain's covered it really well. Thank you.
Yeah. We have a couple of questions here about sort of digital assets and cryptocurrencies. Do you think that pension funds of your size will seriously consider investing in cryptocurrencies or digital currencies within the next 5 to 10 years? Why don't we go to Jeffrey on that one?
Yeah, I think like everyone else, I think we recognize that the distributed ledger technology is one that is fantastic. It allows for verification of holdings and transactions, and it's just so useful in so many ways. And we expect it to be applied much more widely on a range of transactions, including now on sort of if you will, China's, for example, going to apply it to its own kind of PBOC digital currency, and there may be other countries that do that. So I think when you think about some of the crypto assets, I guess the question is, the reason for holding it is that if it's for convenience and verification, and you have a need for a store of value, so long as you believe in government fiat money, then potentially that technology could be applied to fiat money, and then it could be just as convenient, and it's a stable store of value. And would you need to look for a private issuer of those same kind of assets? I think the more complicated question is one where if because of loose monetary policy and the pressures to keep that going, if the value of any certain currency becomes questioned, what should people hold in their stead? What will hold its value? Is it a privately created but limited, very scarce, limited in its production digital asset? Or how would that compare with fiat money, and how would that compare with say an asset like gold? I'm actually not really I don't really have a strong view about that. I think the things you need to believe in for government issued fiat money, you'd need to believe very strongly for privately issued money as well. And it's not clear to me that it's so easy to have that same faith transferred to private money.
Alain, I don't know whether you want to add. Would you pick gold or crypto assets in a end of fiat money scenario?
Well, first, I'm glad Jeffrey got to answer that question first. To be fair, I probably none of the above would be my answer right now. I mean, we all know what drives gold. I think it's a little bit the same for cryptocurrencies. I don't understand how you value them and how you underpin the value of the assets. I think the technology that underpins them is actually quite useful. It will be useful for a number of applications, but as a fund, I don't see CPP investments investing in cryptocurrencies in the short term. You said 5 to 10 years. That's most likely way beyond my career at CPP, so I can't speak for that. Because I'm not as young as Jeffrey, but I don't see us as a value play in the short term in cryptocurrencies now.
Great. I will give you I'll give Alain a needly question now then to answer first. What do you see as the consequences of the new US administration's policies for economic growth?
Well, we don't know yet how they're going to implement those policies. Biden, I assume he'll be Biden at this point. And I think his policies will have to be diluted somewhat based on what we can expect from the Senate. So for economic growth in the US, I think the markets seem to actually like the duality of a Republican Congress and a president with a different approach to institutions. But in terms of the ability to implement real policies on the ground that could affect economic growth significantly, I think he's going to be more limited than his original program intended. And we'll have to see how able he is really to get some of his initiatives through Congress and working with Republicans. I do think, however, that in terms of the international order of things and geopolitical implications, which will drive some kind of economic benefit as well, I think he'll be definitely more proactive, more beneficial. And I think there'll be a renewed sense of cooperation, which may or may not play a little bit against China and lead to more decoupling. But I think in terms of coordination around a number of ideas and issues that need to be tackled by the global community, I think that's going to be positive, and that's entirely within his purview. So I expect it will have a positive impact on the economic growth in the U.S., but perhaps because he won't be able to actually implement a lot of the left-wing policies that the Democratic Party agenda would have wanted to push.
Jeffrey, do you want to, I guess, maybe add to that in sort of, is there a way that you can position your portfolio differently, or is there a way you will position your investments differently given the election result, or do you take these things in your stride?
No, I think we have to see who he chooses for the cabinet, particularly the economic positions and what kind of philosophy and particularly their stance towards regulation. So we'll have to see. I think what is very clear is that whether it's a Democrat or a Republican president, faced with the same kind of economic pressures, will be able to persuade Congress to give them the fiscal room to inject stimulus into the economy. And I think that to me is actually a fact of life that we see not only in the U.S. but we've seen in Europe that they've found ways to issue a common debt that allows them to do some fiscal stimulus, and you've seen fiscal stimulus across many countries in different regions, and I think that that stance towards using fiscal policy will be helpful in what is still an uncertain year. That if in fact recovery doesn't come that easily, or that interim wait until vaccines are widely distributed, is tough economically. I hope that means governments, the Biden government would still be able to enact a fiscal stimulus.
Great. Well, I think we're sort of reaching the end of our panel now, so I'll just come up with sort of one last question to ask you both. And if there's sort of one lesson that you have learned from 2020 that you're going to take forward with your investments into 2021 in the future, sort of what lesson is that, and how will you apply it going forwards? I'll go to Alain first.
Yes, I mean, for us, we had spent quite a bit of time working through scenarios to test the robustness of our portfolio. After the GFC, that was one of the core strategic goals that we had internally, is that let's make sure that we keep on testing on a recurring basis the ability of our portfolio to withstand a shock. The problem with these economic shocks is you never know how they manifest themselves. You can try to plan based on history, but it turns out they all work differently, and this one was no exception. However, I think the work we had done, and probably some people at some point were saying, look, this is just too much. We're spending way too much time trying to test the resilience of our portfolio. But it turns out that actually that worked really well, because we had to test it across a number of different areas. Volatility in different markets, different geographies, liquidity drying up, as Jeffrey alluded to, inability to receive capital back into the fund from Ottawa, from portfolio companies, dividends being suspended, whatever you want. We had different scenarios that we ran over long periods of time that were actually quite varied and very robust in testing the resilience of the portfolio. What we had not anticipated is that all this economic shock would happen in such a tight window. It manifested itself so quickly, and that's probably something that we had not worked out. But at the end of the day, and even being conservative in how we manage capital in the early innings of this pandemic, that proved that, frankly, that work was not only necessary, but actually quite useful. And so our portfolio managed to sail through this period quite well. And we are actually in very good shape now. And I think the most recent results are proving it. So that, to me, is the positive lesson, that work was definitely not in vain. And if anything, we could probably have run a few more scenarios.
Yeah, I'd agree with Alain that stress testing and making sure that your portfolio can really withstand different stresses that you might think are very low probability. I think certainly trying to find solutions that allow you to live through your different stress scenarios is something that definitely will reinforce even more in terms of how we do things. But I think just as importantly, what we didn't expect in this particular crisis was actually the inability to get everybody to come into offices and to work and so on. I mean, thank goodness we are at a point in time when technology is available to convene folks, outside of offices, and everybody had devices that could link in through Zoom or WebEx or whatever system you may use. But we were also very keenly dependent on our staff having kind of worked together closely enough to know each other, to be able to reach out and coordinate decisions and coordinate transfers of information and knowledge and so on. And so I think one of the things, I'm sure it's very true of CPP too, is that the internal culture of a firm and the ability of folks to work together and kind of anticipate what each other are needing to do is very critical to be able to go through periods of stress. And I think certainly both of our firms had to go through that this year.
Perfect. Well, thank you both so much for those lessons and for your time this morning. I found that very insightful. I hope our audience did as well. And thank you to the audience for their questions. This concludes the first panel. I think you're all off to a short networking break now, and then there will be a conversation with Indra Nooyi and Albert Koj later today. Thank you both so much for your time.